it's your attitude to risk and your perception of what's to come, right? Because
you got to guess some interest rates.
yeah, and I mean, you polish your crystal ball and you place your bet and you hope for the best. But it sounds rather dramatic, but it's not that bad. But ultimately, you will be offered choices, all right? You can go for a 2, a 3, a 5-year, even a 10-year fixed rate. There's only one lender doing 30, 35-year sort of fixed rates, but they're not overly attractive.
Not right now.
There's one now.
I mean, not attractive right now. They were a couple of years ago.
They're at 6 point something %. So, it's ridiculously expensive. But I think you've got to look at it and kind of go, right, I bought a house. What am I going to do with that house, right? If I'm buying a house and I've got money and I'm going to do a full, loft conversion, rear extension, I'm going to take that house from being 400,000 to 500, 600,000 pounds. Do I want to be locked in for 5 years? Yeah, maybe not, because I'm going to increase its value. I can then remortgage that property, maybe pull money out, go and do other investments with it. Maybe I remortgage it and go into a lower loan to value, therefore a lower interest rate in 2 years' time because of that uplift in value. That conversation is, going to be more directed towards shorter term interest rates, because as long as the belief is that interest rates are going to be going down, which at the moment they are, those people will be able to get in, get the work done, realize the increased value, lower loan to value, cheaper mortgage rate out the door with something cheaper, all right? The flip side is that you have a conversation with someone who's going, right, and I've got a job at the moment, I want to do this, buy this house, I'm about to have a kid, or I'm about to go self-employed and start a business. We will then have that conversation saying, right, with all these risk factors, maybe going for a 5-year fixed rate to give you time to have the child, sort your finances out, give yourself the 5-year period for your income to be able to appreciate and increase through promotions and, salary increases and things like that. Or if you're going self-employed, you might have, your first 2 years might be quite difficult, but then you've got 3 subsequent years to get your accounts bang on so that when you come to remortgage, you've got all your options. There's fixed rates and then there's tracker rates and variable rates and all the other bits and pieces. And the tracker rates tend to have no early repayment charges associated with them because they're flexible products, but they're not for everybody because generally they're more expensive than fixed rates by quite some significant margin. And although interest rates are headed downwards, it's about how quickly they go down. Are we expected to see them cut 1% off the interest rates in the next 6 months? Probably not. So therefore, going for a tracker rate, you might not be better off. If, they end up cutting fixed rates, you might look back and kind of go, it might have been better for me. But if it's 1% cheaper to do a fixed rate today than a tracker variable rate, you might say, well, actually, over a 2-year period, I'll win for the first year, but then I'll lose maybe for the second year, and the average of those two will net out the same.
How much do you think people should worry about all of this? Because I think it's the kind of stuff that can put people off buying. They just sit there going, oh, rates are going to come down, I'll wait. And
well, I think people should always investigate fully what their options are and understand what they're signing up to. Because if you don't, the chances of you making a mistake are far higher.
This was from our full-length conversation with mortgage broker Anthony Emerson, where we focused on everything you need to know about mortgages. You can watch the full episode right here.